Hey, my name is James Nicholson and welcome to my YouTube channel. Mortgage rates have been dropping. They've been dropping now for around 6 to 7 weeks. This also happened early this year. So should you, if you're looking to refinance your property, maybe remortgage or buy a property, should you fix a rate now or should you wait until mortgage rates come down significantly more? Well, this video, I'm going to cover that for you. I'm going to talk about should you fix, should you get a tracker, 2 years, 5 years, and much, much more in this video. So before we jump into this, if you haven't done already, do subscribe to the channel over there and hit the bell notification. Have a look around this video. You'll see we're so close. You easily could be the 30,000th subscriber. We are a smidge away and we will hit that at some point this weekend. And while you're here, smash like, tickle like, do something to that like button. That helps with the YouTube algorithm. It gets more views on the channel, and that's how we'll get more subscribers. So take a moment to do that right now. So, mortgages. This is one of the most common questions that you guys put. And you'll see when we talk about interest rates or anything like that, this is a very common question. Should I get a mortgage now or should I wait? Because look, the expectation is that interest rates are going to keep going down. But there's a few caveats to that. So the Bank of England, they will normally follow the Federal Reserve. The Federal Reserve this week did a huge cut, 0.5% cut, which really shocked a lot of people and made people feel, is there a recession coming in the USA that they're not being open and honest with? And look, Jay Powell, the head of the Fed, can't say there's going to be a recession, because if he says there's likely to be a recession coming, there will be a recession. The markets will just panic and it will cause its own recession. So he has to talk up things a little bit more. But they did cut significantly. Now, the Bank of England normally follow the Fed. They didn't do that. But some of this is irrelevant because the mortgage rate that you pay or I pay is based off something called the SONIA swap rate. Now, this is the rate that the banks that we borrow off. So we borrow off NatWest, Santander, HSBC, those types of banks. They borrow off bigger banks like JP Morgan, and they borrow at this rate on the SONIA swap. Now, good news is this did drop this week. So this has dropped quite a bit over the last year because the market slowed down so much. So banks, they want to lend banks. The big banks want to lend to the medium-sized banks that we borrow from, and the medium-sized banks want to lend to us. That's how they make money. And so if the market slows down, they'll make money cheaper in order to get more people incentivized to borrow money. So the swap rate did drop. That meant banks now have options to cut mortgage rates to you and I, which some did yesterday. We did a video about that. I think it was Halifax, Virgin Money and Accord on the buy-to-let mortgages that did that so far. So mortgage rates are going to go down. The Americans have said the interest rates are going to drop. The fact that they've dropped 0.5% means that they'll probably drop 0.5% again. The Bank of England is also saying interest rates are on the way down and they will carry on dropping as well. Inflation expectations have improved. Earlier this year, we thought at the end of this year, we would hit 2.8% as the high on inflation. Now that's been revised down to 2.5. It's still an increase on where we are, but it's a better outlook than we were expecting. So SONIA swap rates is something we've got to consider. Let's look at some other stuff that you should consider. Now, do you want to get a 2-year deal or 5-year deal? This is the big question as well. Now, I would say it depends on your personality. Me, I like to take calculated risks. I'm an entrepreneur at heart. So that's what I like to do. So for me, I would bet that the interest rates are going to go down and would go for a 2-year deal. I also like to pull out equity from my properties from time to time in order to buy more property And so I'd rather only be tied into a mortgage for 2 years so I don't have to wait so long to be able to do that. Obviously, that's subjective to the market actually rising in that period of time. So 2 years means that you are banking on rates going down. And the indication is that they are, right? Potentially they are. And so the 5-year deal is going to tie you in for longer, but you might get a better rate today on that. So the banks know that interest rates are likely to come down, so they want to tie you in to a 5-year deal right now. And that's what they're doing at the moment, is they're offering on the whole better deals on the 5-year rates, because that gives you as a customer for longer. Now, what are most people doing? Well, previously, lots of people were taking the 5-year deal about 6 months ago. Now, more people than ever are taking the 2-year deal, banking on the fact that interest rates are going down. Now, with all of this, I would say you need to speak to a broker. You need to know your tolerance for risk. You need to know what your affordability is as well. This isn't financial advice. I'm just saying more people are going for the 2-year at the moment. I'm not saying it's right for you. Go and speak to a broker who can look at your income, your expenditure, and you can then make a decision on that. So 2-year or 5-year is a consideration. Now, this is interesting because this hasn't been a consideration for a long time, and that's fixed or tracker. Fixed or tracker. Now, when interest rates were going up, which they did 14 consecutive times in order to try and push that inflation down, you'd be mad to go on a tracker. And I know some people did. Like, this channel's been going nearly 3 years now, and when the rates started to go up, there was tons of people initially that said, I'm going on a tracker. No one comments that for a long time now, but now trackers are an option to consider. So what a tracker does is they give you a deal, and it'll be slightly above the base rate. The base rate with the Bank of England is 5% at the moment. And if that drops, your mortgage payments will drop immediately the next payment, the next month. So if you feel that interest rates are going to go down, and they're looking like they are, but they could go up. They could go up if inflation does come back for some reason, and they have to increase rates. So you've got to be prepared to take that gamble. But you could get a tracker rate where if you feel interest rates are going to go down, more people are commenting on that in the last month. It hasn't been this case for about a year. Like, no one's been talking about trackers for a long time, but more recently, a few people are commenting on it. Could be an option. Again, speak to a broker. If you're going to look at a tracker rate, I would look at a rate that has the option to get out of it. Some of them, they don't tie you in. You can get a deal that's 2 years maybe, but you can leave without a penalty. Some of them don't have penalties. Try and find a deal like that. So if rates do go up suddenly, you can fix onto a switched and protect yourself, so you're not going to get hit too hard. So that's a consideration here. Now, this next one is something I've been talking about this a lot, and hundreds of people watching this channel have done this. So I want to talk about it more because you may have missed it. Let's just say you've got a mortgage that expires next year, maybe January or February next year. Now it's September. You can do the deal today. So you can go to your existing lender and you can say, hey, look, I want to fix a rate, and they'll give you the best rate that you can get today. Now that new rate won't start till the end of your existing mortgage deal in January or February. So here's what's good. Now, that locks you in your worst case scenario. So if interest rates do suddenly go up, you've got the best rate right now. But if interest rates between now and January or February, before you start your new deal, if they drop, you have to check that your lender allows this, but most lenders will allow you to swap onto a better rate before you start that new deal. Hundreds of you watching this channel have done that and given comments back saying, maybe you done that recently. Do comment and let me know if that's worked for you. But it is something that lots of people do. So you're fixing the rate 6 months ahead. Then if the rates get worse, you've got the best case scenario. If they get better, you can swap before you start that new deal. That is a good strategy to do. My partner did that as the rates were going up. She fixed 4 months early, And in that time, rates went up 3 more times. So she'd fixed the rate early with her existing lender and didn't get hit by those extra increases, if that makes sense. So look, the question that you've got to answer is, do you like risk? If you like risk, you could risk going on a 2-year deal, right? It's not a massive risk. Interest rates are likely to come down. But if you want certainty and you want to sleep at night for the next 5 years, then maybe a 5-year deal at a better rate today is the better option. And then you've just got to stomach it. If the rates suddenly plummet, look, you save the money up front initially, and it is what it is. So let me know in the comments what you think. What would you do? I'd love to know your thoughts or any questions or observations or input, anything else that can help people with this video. Do comment below, do smash like, do share this video. I'm sure you know some people that are considering remortgaging at the moment. Do subscribe. Let's get to 30,000 this weekend. Do check out all the other content on my channel, including this video right here.